Every trader begins with a number on a screen. For some, it's $100, a figure that feels more like a boundary than a beginning. It's the amount people dismiss as insignificant, the kind of capital that others say can't possibly create wealth. But the $100 trader who becomes a millionaire sees that number differently. They don't see limitation, they see a mirror, a reflection of their psychology, patience, and discipline. In trading, the money is never the real asset. The mind is. The difference between the average trader and the one who transforms is not found in strategy, signals, or indicators. It's found in belief. Belief becomes the foundation that holds every emotion, every loss, and every doubt. When the account dips, when a trade fails, when others quit, belief is what keeps the trader calculating instead of collapsing. The market is not designed to test how much you know. It's designed to test how much you trust yourself when your knowledge is challenged. A trader with belief doesn't enter the market looking for validation. They enter seeking verification of their process. They understand that trading isn't about turning $100 into $1,000 overnight. It's about turning uncertainty into understanding. Every candle, every pullback, every rejection zone becomes psychological feedback. They don't just watch the charts, they watch themselves. Belief reshapes perception. When a losing trade happens, the untrained trader says, "I was wrong." The believing trader says, "I was early." One mindset interprets losses as proof of inadequacy. The other interprets them as data for refinement. That difference seems small, but over time it's everything. The market is a reflection of collective emotion. Fear, greed, impatience, and only those who believe in their ability to rise above that noise can navigate it consistently. Most traders fail not because their systems are weak, but because their internal narratives are. They tell themselves stories of scarcity. I can't do much with $100. I don't have enough capital. The market is against small traders. What they don't realize is that the story becomes the system. The subconscious doesn't distinguish between fact and repetition. It builds identity through words. When you repeat weakness, you trade from weakness. When you repeat belief, you trade from power. A $100 trader who believes is already richer than a $10,000 trader who doubts, because the one with belief will find ways to compound skill, not just capital. They will trade micro lots not to survive, but to study. They'll record every trade, analyze every emotional reaction, and refine their approach like a scientist observing patterns. The goal isn't to make money quickly. The goal is to build mental architecture strong enough to sustain success when the money comes. Belief is not arrogance. It's alignment. It's the quiet confidence that your work, your patience, and your process will converge in time. A trader with belief doesn't chase every move, because they understand that opportunity is infinite, but focus is not. They treat the market as a mirror, not a battlefield. When they lose, they don't argue with reality. They adjust to it. They don't say, "The market manipulated me." They say, "My psychology exposed me." Trading psychology is a paradox. The less you need the market to make you feel worthy, the more worthy you become of success. The trader who's desperate to flip $100 into $1,000 in a week is trading from lack. They're emotionally attached to outcome, and attachment distorts judgment. But the trader who sees $100 as a training ground for mental mastery approaches each trade with neutrality. They know that a small say-win is not a curse, it's a classroom. Every losing day teaches them patience. Every winning day teaches them humility. Both are valuable. Belief redefines what progress means. In the beginning, progress isn't measured by profits. It's measured by composure. How fast do you recover from a losing streak? How consistently can you follow your rules when greed whispers? How calmly can you execute your plan while your equity curve fluctuates? That's what builds millionaire habits. Before wealth exists externally, it's earned internally through repetition of mental discipline. The $100 trader who transforms understands that money amplifies psychology. If you're impulsive with $100, you'll be reckless with $10,000. If you panic when you're down $5, you'll collapse when you're down $500. That's why the goal isn't to grow the account, it's to grow the operator. You don't scale money, you scale mindset. Once the mind is calibrated, capital becomes a byproduct. Belief gives the trader a long-term lens. It allows them to detach from short-term fluctuations and focus on structural growth. They study market behavior with curiosity, not fear. They understand that every professional once traded with limited funds, but unlimited vision. They know that financial transformation begins with identity transformation. To become a millionaire trader, you must first think like one before the results appear. There's a psychological shift that happens when belief matures. The trader stops thinking like a participant and starts thinking like a creator. Instead of reacting to the market, they respond to it. Instead of fearing volatility, they anticipate. Instead of chasing signals, they build frameworks. This mental evolution separates those who gamble from those who grow. Every chart tells a story, but only belief allows you to read it without distortion. When fear controls the narrative, you'll see danger in every setup. When greed dominates, you'll see opportunity where there's only risk. But when belief anchors you, you interpret data without emotional interference. You become objective, precise, and patient. Qualities that compound exponentially in both trading and life. Belief over balance means understanding that the size of your account doesn't dictate the size of your potential. The market doesn't care how much you start with, it only mirrors how you think. Two traders can take the same trade. One makes money, the other loses. Not because the market was different, but because their mindset was, one traded to prove something, the other traded to learn something. The latter always wins in the long run. When a trader truly believes, they no longer feel the need to rush. They understand that compounding is not just a mathematical process. It's psychological. Every day of discipline compounds into confidence. Every day of emotional control compounds into consistency. And every day of belief compounds into inevitability. Millionaire traders aren't born from luck or leverage. They're born from layers of self-trust built over time. Belief doesn't eliminate fear, it refines it. Fear becomes awareness rather than paralysis. It turns into risk management rather than avoidance. The $100 trader who believes learns to use fear as feedback. Instead of saying, "I'm scared to lose," they ask, "What is this fear revealing about my attachment?" That question alone transforms the entire trajectory of their growth. The psychology of belief operates in silence. It's not loud confidence, it's quiet preparation. It's the 4 a.m. chart study, the journal entries after losing trades, the self-talk that rewires doubt into discipline. The trader who believes doesn't announce their vision. They prove it through repetition. Their results become their language. Belief is a filter. It determines what information you absorb and how you interpret it. A trader without belief sees challenges as confirmation that success is out of reach. A trader with belief sees challenges as checkpoints that success is near. The same reality, two different mental lenses. The one who keeps showing up eventually becomes the one the market rewards, not because the market favors them, but because consistency compounds certainty. Every professional trader was once a beginner who believed irrationally. They believed before results existed, before systems were perfect, before others understood their vision. Belief is irrational in the eyes of the doubter, but essential in the psychology of mastery. It's what keeps you placing trades when nothing seems to work, refining strategies when no one's watching, and staying patient when everyone else is chasing volatility. The greatest illusion in trading is that you need more money to succeed. The truth is, you need more mastery. The larger account won't fix emotional instability. It magnifies it. But belief, real belief grounded in discipline, transforms $100 into a laboratory for greatness. It's not the balance that makes the trader. It's the belief that shapes the balance. When you believe, you begin to act differently. You stop overtrading because you trust that missing a move isn't missing success. You stop revenge trading because you understand that discipline is your true edge. You stop comparing your journey to others because you realize that markets reward individuality, not imitation. Belief builds patience, and patience builds power. The $100 trader who commits to belief doesn't dream of fast profits. They dream of lasting growth. They know that wealth doesn't just require skill. It requires psychological stability. It's not about beating the market. It's about mastering the self that interacts with it. Belief creates detachment. When you no longer measure your worth by daily profits, you begin to trade with freedom. And that freedom allows clarity. You start seeing trades as probabilities, not guarantees. You start understanding that every loss is tuition for a greater education. You realize that markets aren't against you. They're neutral. It's your interpretation that gives them meaning. Over time, belief becomes identity. You no longer say, "I'm trying to be a trader." You say, "I am one." And with that identity comes responsibility. To act like the trader you claim to be. To execute with integrity. To study without excuses. To protect your capital with intention. That alignment between identity and action is where transformation truly begins. Belief over balance is more than a mindset. It's a way of living. It means understanding that every trade is a psychological mirror reflecting who you are in that moment. Disciplined or impulsive, patient or anxious, trusting or doubtful. It's the mental framework that separates those who quit from those who conquer. It's not about how much you start with. It's about how deeply you believe in your ability to evolve beyond where you started. Belief turns capital into catalyst. It transforms hesitation into conviction. It redefines what's possible when logic says you shouldn't even try. The market will always test belief. It will take your patience, shake your confidence, and whisper that it's not working. But that's exactly what the transformation demands. A breaking of the old self. So a disciplined trader can emerge. The $100 trader who holds on to belief through the storm eventually becomes the one who doesn't just trade the market, but understands it. Because in the end, belief doesn't follow success. Success follows belief. In trading, the obsession with profit is what quietly destroys most traders before they ever truly begin. They enter the markets with one thought. How much can I make? And that thought becomes the invisible anchor that drags them into emotional chaos. The trader who transforms, the one who builds longevity from a small beginning, thinks differently. They are not hunting dollars. They are building discipline. They don't chase outcomes. They chase execution. They understand that the process is the only thing within their control, and the market will always decide the rest. When traders focus on profit, they create dependency on something they cannot control. Price movement is external, unpredictable, and often irrational. But when they focus on process, they shift the power back inward. The process becomes the compass that guides through uncertainty, the system that holds the trader steady when volatility shakes confidence. A trader obsessed with the process understands that profit is not a goal, it's a side effect. The process-driven trader begins their day differently. They don't open their charts looking for instant opportunities. They open them to study structure, to understand context, to synchronize their psychology with the rhythm of the market. Each session is treated like practice, a space to refine consistency. They journal their trades, not to brag about wins, but to dissect their behavior. They know that trading isn't about how much money they make on any given day, but how accurately they can execute the same discipline under changing conditions. Process orientation creates detachment from emotion. The market's ups and downs lose their power when your focus shifts from outcome to execution. When you measure success not by profit but by how well you followed your plan, you begin to build the kind of internal control that wealth demands. You start to feel grounded, even when your account fluctuates. This is where true consistency begins, not from technical precision, but from emotional neutrality. Every professional trader learned this lesson through pain. They once chased the market too. They once believed that more trades meant more gains. They once thought that missing a move meant missing success. But eventually, they learned that the trader who wins is not the one who trades the most, but the one who trades with the most patience. The one who executes a small set of rules over and over until it becomes second nature. The process becomes ritual. It becomes the architecture that protects the mind from its own impulses. Trading psychology at its core is about managing the relationship between the trader and uncertainty. The process is the structure that makes uncertainty tolerable. Without it, the market becomes chaos. Every tick feels like a test of self-worth. Every fluctuation feels personal. But when a process exists, the trader interprets those same movements as data. They respond instead of react. They make decisions from clarity, not emotion. A process-oriented trader doesn't measure progress daily. They measure it over hundreds of trades. They understand that the outcome of any single trade is meaningless in the grand scheme. The only thing that matters is statistical edge and psychological consistency. This is why the trader who focuses on process will always outperform the one who focuses on results. One builds foundation, the other builds frustration. The difference between amateurs and professionals is not information, it's interpretation. Amateurs interpret profits as validation. Professionals interpret process as progress. When a professional has a losing day but executed flawlessly, they celebrate. When an amateur has a winning day from a bad decision, they become overconfident, unaware that their inconsistency is compounding against them. The process trader understands that long-term profitability is built on short-term discipline, not short-term excitement. Process transforms the way you experience losses. A loss is no longer a punishment. It becomes feedback. It becomes a mirror reflecting the health of your system. Was the trade valid according to your plan? Did you size correctly? Did you exit emotionally or strategically? Each question reinforces accountability, and accountability is what shapes mastery. When profit is your focus, you avoid accountability because every loss feels like failure. But when process is your focus, you invite accountability because every loss feels like learning. Most traders are addicted to dopamine, not discipline. They want the thrill of quick results. But the process-driven trader has rewired their reward system. Their satisfaction doesn't come from profit notifications. It comes from executing with precision. That internal rewiring is what separates fleeting success from sustainable growth. Because in the end, your trading results will always mirror what your brain finds rewarding. If you reward impulsivity, you'll trade impulsively. If you reward discipline, you'll trade consistently. A trader devoted to process builds their environment around structure. Their workspace is intentional. Their trading journal is active. Their pre-trade checklist is sacred. They don't treat preparation as optional. They treat it as the trade before the trade, because they know that every mistake that shows up on the chart started long before the execution. It began in mindset, in lack of preparation, in emotional noise left unaddressed. The process neutralizes all that. It brings logic where emotion once lived. When you commit to process, you start thinking in probabilities instead of predictions. You understand that no trade guarantees profit, but every trade reveals information. That shift changes everything. You stop trying to force certainty in an uncertain environment. You start to dance with the market rather than fight against it. Each setup becomes part of a statistical series, not a do-or-die event. That mental shift reduces pressure, and when pressure decreases, performance improves naturally. The process is also what builds resilience. Every trader will experience drawdowns, not just in equity, but in confidence. The difference is that process gives you a roadmap back to equilibrium. When your confidence is shaken, you have something objective to return to. Your system, your journal, your plan. You can analyze, recalibrate, and continue. But without process, a drawdown becomes identity collapse. The trader begins to question not their strategy, but their worth. That's why process isn't just technical, it's psychological armor. The irony of trading is that the less you focus on making money, the more consistently you make it. Because when you stop chasing results, you stop making emotional decisions. When you stop forcing trades, you start allowing setups. The market rewards patience disguised as logic. Process gives you that patience. It keeps you grounded in the present, focused on execution, not expectation. Process-oriented traders know that perfection doesn't exist. They don't aim to eliminate mistakes. They aim to reduce them systematically. They understand that improvement is incremental, and progress is built through micro-adjustments, refining entries, tweaking stop placements, improving emotional control one decision at a time. This mindset turns trading into craftsmanship. Every session becomes an opportunity to sharpen the edge, not to chase euphoria. This mindset requires humility. To truly commit to process, you must accept that you don't control the market. You only control your preparation, your reaction, and your discipline. Humility opens the door to growth. The ego wants profit now. Humility wants mastery forever. The ego says, I deserve to win. The process says, I deserve to learn. The difference is subtle, but it determines longevity. When process becomes your focus, the market starts feeling slower. You begin to see patterns more clearly. Because your mind is calm, You're not chasing every flicker of movement. You're observing with precision. You're no longer reacting to noise. You're tuned into rhythm. This state of calm concentration is what elite traders call flow, the merging of psychology and strategy into seamless execution. And flow only emerges when the mind is detached from outcome. The process trader doesn't fear repetition. They revere it. They understand that mastery is built in monotony, reviewing the same setups, refining the same entries, practicing patience day after day. That's where confidence is forged. The mind seeks novelty, but markets reward repetition. The beginner wants excitement. The professional wants efficiency. The professional knows that once the process is perfected, trading becomes boring, and boring is profitable. Every trader eventually realizes that success is not about finding the perfect system, but perfecting their relationship with their system. The process trader doesn't jump from one strategy to another at every losing streak. They analyze, they adjust, they evolve, but they stay committed. Consistency compounds only when the variables remain stable long enough for skill to mature. Constant change in pursuit of comfort only delays competence. The market respects discipline. It doesn't owe anyone profit, but it rewards patience, structure, and consistency. A process trader isn't emotionally tied to being right. They're emotionally tied to following their plan. This detachment gives them psychological freedom. When you no longer define yourself by the outcome of a trade, you start thinking clearly. You start making decisions based on logic, not ego. Focusing on process builds a deeper level of self-awareness. You begin to notice your triggers: impatience after a loss, overconfidence after a win, hesitation during uncertainty. You start understanding that your emotions are indicators just like RSI, or volume. They provide data. When you respond to that data consciously, you start managing not just trades but the trader within. The more aware you become, the less control emotions have over you. Process is what transforms trading from chaos into craft. Every chart pattern, every price movement, every journal entry becomes part of a larger symphony of consistency. The trader begins to see the connection between daily discipline and long-term outcome. They understand that compounding is not only financial, it's psychological. Small acts of consistency compound into large shifts in confidence. In the end, process over profit becomes a way of living beyond trading. It teaches patience in uncertainty, focus under pressure, and clarity amidst chaos. The same discipline that refines trades, refines thought. The same mindset that manages risk, manages life. The trader begins to realize that their greatest investment isn't in the market, it's in their mindset. The $100 trader who focuses on process is already operating like a millionaire, because they've shifted their attention from external validation to internal mastery. Every trade becomes a reflection of character, not luck. They don't ask, how much did I make today? They ask, how well did I execute today? And that question alone reshapes their trajectory forever. Process builds momentum. Each disciplined action reinforces belief, and belief reinforces discipline. The loop strengthens until consistency becomes identity. The trader no longer needs motivation. Process becomes instinct. They no longer depend on the market for confidence. They create it through execution. The process doesn't guarantee that every trade will win. It guarantees that every trade will teach. And when the trader learns deeply enough, profits become inevitable. They no longer chase them. They attract them through precision, patience, and presence. The process is the quiet revolution inside every great trader. The invisible force that turns a $100 dream into a $1 million reality through the slow, deliberate mastery of self. In the fast-moving world of trading, where every second seems like an opportunity and every tick of the chart feels like a test, patience stands as the most underrated and misunderstood advantage a trader can possess. Many traders come into the market believing that success belongs to those who move quickly, who react instantly, who seize every opportunity they see. Yet the reality is that the traders who rise above the noise, who build empires from small beginnings, are not the fastest, but the calmest. They understand that the market rewards timing, not urgency, and that patience is not the absence of action, but the mastery of restraint. Patience in trading psychology is not a passive quality. It is an active mental discipline, forged through experience, emotional regulation, and self-awareness. It requires the ability to observe without reacting, to prepare without forcing, and to trust the process without immediate proof of success. The impatient trader looks at the market as something to conquer. The patient trader sees it as something to understand. This difference in perception shapes every decision, every entry, every exit, and ultimately, every outcome. The impatient trader is addicted to motion. They feel uncomfortable in stillness. They chase setups that aren't ready. Force trades out of boredom and interpret quiet market periods as missed opportunities. To them, waiting feels like losing. But to the patient trader, waiting is the trade. Every minute they spend observing, analyzing, and aligning with market rhythm is a calculated investment in timing. They know that missing a trade is cheaper than forcing a bad one. They know that silence is part of strategy, not a sign of stagnation. Patience is the skill that separates those who gamble from those who grow. It is the internal mechanism that keeps emotions in check when volatility tries to provoke reaction. The market feeds on emotion, fear and greed are its currency, and patience is the resistance against that pull. When others jump in impulsively, patience holds the line. It allows the trader to remain objective when chaos erupts, to act with clarity when others act with desperation. To understand patience, one must first understand time. Trading is not about beating the market within a day, a week, or a month. It's about compounding consistency across years. The millionaire trader didn't build wealth by rushing. They built it by repeating the right actions over long stretches of time. Each waiting period strengthened their discipline. Each avoided mistake preserved their capital. Each deliberate pause was a decision to protect progress. Patience transforms time into leverage, converting delayed gratification into exponential growth. Most traders underestimate how psychological time can be. When you're attached to outcomes, every minute of waiting feels heavier. Impatience compresses perception. It makes time feel longer and emotions more intense. The mind starts creating stories. What if I missed this move? What if this was the chance? Those thoughts are not strategy. They are the ego demanding control over something it doesn't have. The patient trader understands this and resists the need to control time. They know that their job is not to predict when the market will move, but to prepare for when it does. Patience is what keeps the trader aligned with reality. It prevents illusion from taking over. When you are patient, you don't try to impose your will on the market. You flow with it. You don't trade because you want something to happen. You trade because something has happened. That shift from anticipation to confirmation is where consistency is born. The impatient trader assumes, the patient trader waits for proof. The market always rewards proof. Every chart tells a story, but you can only read it clearly when your mind is still. The impatient mind sees what it wants to see, a breakout that isn't real, a reversal that hasn't formed, a setup that hasn't matured. The patient mind sees what's actually there. Patience enhances perception. It slows the internal noise enough for logic to emerge. It allows the trader to see structure, not chaos. Patterns, not randomness. Patience is also the foundation of risk management. Without it, no amount of technical knowledge can save a trader. An impatient trader moves their stop loss out of fear, doubles position size to recover losses, or enters too early because they can't wait for confirmation. Each of these actions destroys capital, not because the market was wrong, but because the trader couldn't wait. The patient trader, in contrast, accepts small losses without emotional reaction. They know that protecting capital is not weakness, it's wisdom. They know that surviving today ensures the ability to profit tomorrow. There is a profound psychological power in being able to wait. When you're patient, you communicate to yourself that you are not dependent on the market's pace. You're in control of your behavior, even when you're not in control of the outcome. That self-control breeds confidence, and confidence without arrogance is the rarest currency in trading. It allows the trader to operate from stability rather than from need. The paradox of trading is that most people enter it seeking freedom. Freedom from jobs, schedules, or financial limits. Yet they imprison themselves with impatience. They crave instant results, quick wins, immediate validation. They become slaves to every price fluctuation, checking charts compulsively, unable to disconnect. The patient trader experiences true freedom because they have conquered the need for constant engagement. They can step away, they can wait, they can trust. That's not laziness, that's mastery. Patience also builds confidence through data, not emotion. The patient trader journals every trade, not just to record outcomes, but to analyze behavior over time. They see patterns in their impulsiveness, recognize their psychological cycles, and adjust. Patient traders repeat mistakes. Patient traders refine them over weeks and months. They begin to notice that the less they trade, the more they make. Not because they're doing less, but because they're doing better. Precision replaces frequency, and patience turns into profit. Patience has a rhythm. It's not static, it breathes with the market. During slow times, it's calm observation. During volatile times, it's controlled execution. During drawdowns, it's emotional endurance. The trader learns to flow between these states, adapting without forcing. They know that sometimes, the most profitable decision is to do nothing. To not trade is still a decision, a powerful one, rooted in patience and clarity. Every trader faces the temptation of overtrading. It comes disguised as productivity, the illusion that more trades equal more chances to win. But trading more often only increases the probability of making emotional errors. The patient trader recognizes this trap early. They define their edge and protect it by filtering out noise. They would rather take one high-quality trade a week than 10 impulsive ones a day. Their focus is not on being busy, but on being precise. Patience redefines what success looks like. Instead of asking, "How much did I make today?" the patient trader asks, "How well did I wait?" This question may sound strange to outsiders, but it's the essence of professional psychology. Waiting well is not inaction. It's strategic observation. It's the art of aligning timing, confirmation, and execution into one cohesive flow. When that alignment happens, trades feel effortless because the preparation has already done the work. Every trader reaches a point where they realize that the market is not their opponent, their impatience is. The real battle is not on the screen, but within. Every time you rush into a setup, you're saying, "I don't trust my discipline." Every time you chase a missed move, you're saying, "I fear missing out more than I value consistency." Patience eliminates these internal contradictions. It centers the trader in logic, grounding them in truth. The market will always be there, but your capital won't if you keep forcing it. Patience also amplifies intuition. When you've observed markets long enough without reacting impulsively, your subconscious begins to notice patterns that your conscious mind misses. You develop a quiet intuition, not a guess, but a sense shaped by data and experience. This intuition doesn't come from overtrading. It comes from deep observation. It's the kind of understanding that only time and stillness can produce. In psychology, delayed gratification is one of the strongest predictors of long-term success. Trading is a living embodiment of that principle. Every trade you skip, every setup you wait for, every emotion you manage instead of obeying. These moments accumulate into mental strength. Over time, this strength compounds into consistency. The trader who can delay gratification today can handle larger opportunities tomorrow. The one who can't will sabotage every gain with impatience. Patience also transforms how traders experience losses. Instead of reacting with frustration, they interpret them as statistical inevitabilities. They don't seek revenge on the market. They seek refinement in themselves. They take time to breathe, to analyze, to realign. This delay between loss and reaction creates space for wisdom. That space is where professional growth occurs. Impatience collapses that space. It replaces reflection with reaction. And that's where traders lose, not just money, but perspective. A patient trader understands that the goal is not to win every trade. It's to survive long enough for probability to work in their favor. They know that consistency isn't built in a day, but it can be destroyed in one impulsive moment. So they protect their time, their focus, and their capital with vigilance. They trust that waiting is not weakness, it's weaponized discipline. Patience also teaches emotional intelligence. It trains the trader to sit with discomfort instead of escaping it, to endure uncertainty without collapsing into anxiety, to witness market noise without internalizing it. Over time, this emotional endurance spreads beyond trading. It influences relationships, decisions, and mindset. The trader becomes calmer, more deliberate, more aware. The markets stop being a storm to survive and become a sea to navigate. The power of patience is that it compounds invisibly. At first you don't see the results. You heal the restraint. The trades not taken, the moves not chased. The time spent waiting. It feels like nothing is happening. But beneath that stillness, skill is forming. Each moment of restraint builds neural pathways of discipline. Each day of observation strengthens intuition. Each pause trains emotional control. Months later, when the trader looks back, they realize that patience didn't just protect their capital. It built their character. The trader who truly understands patience begins to view the market as a long-term relationship rather than a series of short-term interactions. They treat every session as part of a larger narrative. They no longer measure success by immediate results, but by cumulative growth. They don't panic during drawdowns because they've experienced enough cycles to trust recovery. They don't chase rallies because they know that opportunity never ends. The market moves in infinite waves, and patience is the surfboard that keeps them balanced across all of them. The greatest traders are not defined by how much they trade, but by how long they can wait for the right moment. Patience transforms average setups into high-probability trades. It turns volatility into opportunity, and boredom into strategy. It is not just a skill, it is a state of mind, cultivated through repetition, reflection, and self-control. When a trader develops patience, they stop competing with others. They realize that most people lose not because of the market, but because they can't sit still. They can't let a plan unfold without interference. The patient trader sees this and gains an edge, an invisible one that no indicator can replicate. The ability to wait with intention becomes their quiet superpower, one that operates beyond charts, beyond time frames, beyond tactics. Patience is the edge that compounds everything else: knowledge, skill, and capital. Without it, every advantage disintegrates under emotional pressure. With it, every setback becomes part of a larger structure of growth. The market does not reward speed. It rewards composure. The $100 trader who learns to wait will always outlast the one who rushes to win. Because in trading, the slow mind becomes the steady hand, and the steady hand always builds the legacy. Every trader enters the market with the illusion that mastery means control. Control over price, over direction, over outcomes. They stare at charts and indicators as if staring hard enough could influence where the next candle forms. But the truth that only experience reveals is that no one can control the market. The market moves with billions of decisions made by others, with patterns driven by collective emotion and probability. The only true control that exists lies within the trader, in their reactions, their composure, and their emotional discipline. Emotional control is the invisible skill that turns chaos into opportunity, and without it, even the best strategy is useless. When traders begin, they focus entirely on technicals. They study indicators, candlestick formations, and algorithms, believing that precision and prediction will make them untouchable. Yet, as soon as a losing streak hits, all that knowledge evaporates under the pressure of emotion. They start second-guessing themselves, revenge trading, breaking rules they once swore by. This cycle doesn't end because of lack of skill. It ends because of lack of control. Emotional instability erodes consistency faster than any bad setup ever could. The truth is simple, but brutal. You cannot control the market, but you must control yourself. The moment you try to fight the market, you lose twice, once in money and again in mindset. The market doesn't punish traders, it exposes them. It exposes impatience, greed, fear, ego, and self-doubt. Every chart becomes a psychological mirror. The red candle doesn't just show price decline. It shows how quickly you lose composure. The green candle doesn't just show profit. It shows how easily euphoria clouds logic. The emotionally controlled trader reads both without bias. Trading is not about predicting what happens next, but about responding to what happens now. Emotional control is the bridge between stimulus and response. A disciplined trader can watch a trade go against them and still act rationally. They don't react impulsively to price movements because they understand that emotion distorts perception. When fear takes over, you see risk everywhere. When greed takes over, you see opportunity everywhere. Both are illusions. The controlled trader waits until data confirms reality. Fear is the first emotion every trader must conquer. It appears in many forms: fear of loss, fear of missing out, fear of being wrong. Each one leads to irrational decision-making. The trader who fears loss exits too early, sabotaging potential profits. The one who fears missing out enters late, chasing momentum that's already fading. And the one who fears being wrong refuses to accept loss, turning small mistakes into massive drawdowns. Fear is not eliminated by strategy. It's managed by awareness. The trader who acknowledges fear without obeying it gains true control. Greed, on the other hand, disguises itself as ambition. It convinces the trader that one more trade will multiply profits, that over-leveraging is justified because the setup feels right. Greed clouds objectivity, inflating confidence until discipline dissolves. The market doesn't destroy traders through losses. It destroys them through overconfidence built on emotional highs. The emotionally intelligent trader understands this. They treat greed like a wild current, powerful if directed, deadly if followed blindly. Ego is the most dangerous emotion in trading, because it masquerades as confidence. It whispers that you can outsmart the market, that losses are temporary setbacks that can be erased by force. Ego turns learning opportunities into personal battles. It makes the trader forget that the market owes them nothing. Ego seeks validation, mastery seeks growth. Every time a trader takes revenge on the market, they are not trading data. They are trading emotion, and emotion always loses to structure. The key to emotional control is detachment, not from the market, but from outcomes. Detachment doesn't mean interference, it means balance. You can care deeply about improvement, while remaining indifferent to short-term results. The emotionally controlled trader measures success, not by profits, but by precision of execution. If the trade was planned, executed, and managed correctly, the result doesn't matter. This mindset frees the trader from emotional volatility. It turns every trade into data rather than drama. The market is a battlefield of psychology. Every trader you compete against is struggling with the same emotional demons: fear, greed, doubt, impatience. The few who master control rise above this collective chaos. They don't get swept into emotional waves, they ride them. When others panic during volatility, they see opportunity. When others become euphoric during rallies, they stay cautious. Their edge is not superior prediction, but superior emotional posture. Emotional control is built through repetition and reflection. No one becomes calm by accident. The trader must intentionally train their emotional muscle through journaling, review, and mindfulness. Every trade offers feedback not just on market structure, but on personal structure. Did you follow your plan? Did emotion influence your exit? Did you size according to logic or impulse? Honest answers to these questions reveal where control weakens. By tracking emotions as diligently as price, the trader begins to build internal discipline stronger than any trend line. To control emotion, you must first accept it. Suppression doesn't work. It only delays reaction. The goal is not to feel nothing. The goal is to feel everything without losing focus. A professional trader feels fear when risk rises, but doesn't let it dictate behavior. They feel excitement when profit grows, but remain composed. They experience frustration after losses, but don't act from it. Emotional control means allowing emotion to exist without surrendering decision-making to it. Visualization plays a powerful role in emotional mastery. Before entering a trade, the controlled trader visualizes all outcomes: winning, losing, breaking even. They prepare their mind for every possibility, so no scenario feels unexpected. This mental rehearsal reduces emotional spikes. The mind reacts most violently to surprise. When nothing surprises you, everything becomes manageable. Breathing, meditation, and deliberate pauses are underrated tools in trading psychology. A single deep breath between impulse and execution can prevent catastrophe. A 10-minute break after a loss can save an entire week's profit. These small acts of emotional reset create distance between thought and action, giving logic time to re-enter the conversation. The most profitable decisions often happen in that space of silence. Self-awareness is the foundation of control. Each trader has emotional triggers, market conditions, or patterns that provoke irrational responses. Some react strongly to volatility, others to long consolidations. Some get euphoric after wins, others spiral after small losses. The controlled trader identifies these patterns through introspection. They don't just study price behavior, they study self-behavior. Emotional mapping becomes as important as market mapping. When emotional control becomes habit, trading transforms from stress to strategy. The mind no longer sees each fluctuation as threat or promise. Instead, every movement is data to be processed calmly. The chart becomes quiet, not because the market changed, but because the trader did. Emotional noise disappears, replaced by focused observation. This psychological stillness is what professionals operate from. They move slowly, deliberately, as if time itself expands around them. Control also manifests in how a trader reacts to external noise, social media hype, news releases, or opinions of others. The emotionally controlled trader doesn't let external excitement dictate internal decisions. They understand that markets feed on attention, and that collective emotion often drives false moves. They don't follow narratives, they follow evidence. While others trade headlines, they trade setups. Emotional control gives them the confidence to stay independent in a world addicted to influence. In moments of volatility, emotional control becomes the ultimate shield. When a market crashes or rallies aggressively, untrained traders freeze, panic, or overreact. Controlled traders act within predefined parameters. They have rules for chaos. They know exactly when to cut losses, when to sit still, and when to capitalize. Their decisions are mechanical because they planned for the emotional storm before it arrived. This foresight is not luck. It's discipline fortified through self-mastery. The relationship between emotional control and consistency is direct. The more stable your emotions, the more consistent your execution. Consistency doesn't come from perfect entries, but from controlled reaction. You can have the best trading system in the world, but if fear or greed interfere, it's worthless. Emotional control turns theory into practice. It's what allows you to execute the same plan under pressure, again and again, without deviation. The emotionally intelligent trader learns to detach their identity from their results. Losses don't define their worth, and wins don't inflate their ego. They see both as natural parts of probability. This neutrality creates freedom, the ability to operate without psychological distortion. They don't need the market to affirm their intelligence. They need it to test their discipline. One of the hardest lessons to learn is that emotional control is not built during calm markets, but during chaos. It's forged in drawdowns, mistakes, and losses. Every setback becomes emotional training. The trader learns not to panic when red candles flood the chart. They learn to stay composed when profits vanish in seconds. With every test, emotional tolerance increases. This resilience becomes their invisible armor, the strength that protects them when others break. The beauty of emotional control is that it compounds. The more you practice it, the easier it becomes. Every moment you choose patience over impulse, calm over chaos, you rewire your brain. Neural pathways of discipline grow stronger, and emotional volatility weakens. Eventually, what once triggered panic now triggers observation. What once caused anxiety now sparks analysis. This transformation doesn't happen overnight, but when it does, it changes everything. Control is not about never feeling emotion, it's about never letting emotion make decisions. The trader who can sit through a drawdown without panic, who can hold a winning position without greed, who can accept a loss without despair, is the one who truly understands the psychology of success. Because in trading, the market is neutral. Only your perception gives it meaning. Control your perception, and you control your performance. Every professional trader knows that emotional control is a daily practice, not a permanent achievement. The mind must be recalibrated constantly. Some days the control is natural, other days it's forced. But what matters is that the trader never stops practicing. Emotional discipline is like muscle. It strengthens through use and weakens through neglect. Each trade, win or lose, becomes an opportunity to train it further. The illusion of market control will always tempt traders. They will search for perfect strategies, infallible systems, magic indicators, but none of these can control what truly matters: their own state of mind. The emotionally controlled trader understands that success doesn't come from dominating the market, but from mastering the self that trades it. The candles, patterns, and prices will always move unpredictably, but emotional control turns unpredictability into advantage. Through control, traders achieve clarity. They no longer overtrade to chase excitement or undertrade out of fear. They find balance, a rhythm where emotion and execution coexist without conflict. This balance is rare, yet it is what transforms trading from chaos into calm creation. Every professional's journey converges on this truth. The market rewards not the most intelligent, but the most emotionally stable. Emotional control becomes the invisible edge that separates temporary winners from timeless masters. In the psychology of trading, few traits separate survivors from casualties more clearly than adaptability. The market is a living organism, fluid, unpredictable, constantly evolving. What works today may fail tomorrow, and what failed last month might suddenly start printing profits. The traders who last are not those who are always right, but those who adjust faster than they fall. Accuracy gives the illusion of mastery, but adaptability gives the reality of longevity. The trader who clings to being right will break under the weight of changing conditions. The trader who adapts will bend, recalibrate, and continue. Adaptability is not weakness, it's intelligence in motion. It's the acknowledgement that certainty doesn't exist, that the market owes no trader consistency, and that flexibility is the only consistent edge. Every rigid mindset eventually collapses because the market is designed to expose inflexibility. Trends reverse, volatility shifts, liquidity dries up, and what once felt predictable suddenly feels alien. The adaptive trader expects this. They don't try to predict the future. They prepare for the unpredictable. They thrive in uncertainty because they've learned to use it as fuel. The need for accuracy is a psychological trap that feeds ego. It convinces traders that being right validates their intelligence. But trading is not about being right. It's about making money. You can be wrong 5 times and still profitable if your losses are controlled and your adaptability keeps you aligned with the next opportunity. The market doesn't care about your opinions. It rewards your ability to respond to change without emotional resistance. Adaptability begins in mindset. The rigid trader seeks comfort. The adaptive trader seeks truth. The rigid trader says, the market should do this. The adaptive trader asks, what is the market doing right now? The difference between should and is determines whether you trade illusion or reality. The market does not bend to your expectations. It bends to the weight of collective psychology. To fight that current is to drown in your own stubbornness. The adaptive trader studies patterns, not to predict them perfectly, but to recognize when they're breaking down. They understand that setup have lifespans. No strategy is immortal. A trader attached to a system that once worked but now fails is like a soldier using old maps in a new war. The terrain has changed, but their mindset hasn't. The adaptive trader doesn't worship a method, they evolve it. They test, refine, discard, and rebuild, always keeping curiosity alive and ego quiet. Adaptability requires emotional humility. To adapt, you must first admit that you don't always know. This is difficult for the mind that equates mistakes with failure. But in trading, mistakes are data. Every loss, every unexpected move, every broken pattern reveals new information. The adaptive trader sees losses as language, messages from the market that guide adjustment. They don't take it personally, they take it professionally. They extract insight instead of insecurity. Accuracy makes traders rigid. Adaptability makes them resilient. Accuracy feeds control, adaptability embraces chaos. The market has infinite variables: news, algorithms, macro events, liquidity flows, and to believe that accuracy alone can conquer this complexity is a form of psychological arrogance. Adaptability, on the other hand, accepts the market's volatility as part of the structure. The trader who adapts doesn't need certainty, they need awareness. They operate in probabilities, not absolutes. They build systems that breathe with the market, instead of breaking against it. The adaptive trader's psychology is rooted in observation. They don't react impulsively to every fluctuation. They analyze the context behind movement. They study not just direction but behavior. How volume shifts, how volatility compresses, how reactions differ across sessions. This observation trains intuition, the kind that comes from deep engagement with change, rather than blind confidence in patterns. Over time, adaptability becomes instinct. They can feel when something's off, even before indicators confirm it. That awareness doesn't come from prohibition. It comes from presence. Adaptability also demands emotional balance. To pivot quickly, a trader must detach from ego-driven narratives. They can't afford to be emotionally attached to setups, strategies, or biases. The need to be right creates paralysis. The willingness to adapt creates freedom. When market conditions invalidate their thesis, they don't argue with reality. They move on. This psychological fluidity is rare because it requires both courage and surrender. Courage to face uncertainty and surrender to what the market reveals. An adaptive trader knows that survival comes before success. They treat every changing condition as a test of mental flexibility. When volatility spikes, they don't force trades out of fear. They tighten risk or step back. When the market trends aggressively, they adjust position sizing and risk tolerance. When it consolidates, they shift to patience mode, waiting for structure. Every change in market behavior demands a change in trader behavior. The traders who refuse to evolve emotionally or technically are the ones the market quietly eliminates. Adaptability is also an antidote to overconfidence. After a winning streak, the untrained trader begins to believe they've mastered the market. They increase size, ignore risk, and start confusing luck for skill. But the adaptive trader views success with caution. They understand that winning doesn't guarantee permanence. They remain students, never experts, because they know the market can humble anyone at any time. Their mindset is one of curiosity rather than conquest. They ask, "What is this teaching me?" instead of "How do I prove I'm right again?" The mind that values accuracy over adaptability becomes fragile. It breaks under pressure because it's addicted to validation. Every losing trade becomes an identity crisis. Every market shift feels like betrayal. The adaptive mind, on the other hand, remains calm because it expects impermanence. It sees every change not as loss, but as evolution. This detachment allows for growth without psychological friction. The trader becomes like water, shapeless but powerful, soft yet unstoppable. Adaptability also shapes how a trader perceives failure. In rigid psychology, failure means defeat. In adaptive psychology, failure means feedback. A losing streak doesn't destroy confidence. It refines clarity. The adaptive trader doesn't ask, "Why is this happening to me?" but "What is this teaching me about the market, or about myself?" This mindset keeps the emotional system stable, even in adversity. They use setbacks to upgrade strategies, not to downgrade self-worth. Adaptability thrives on awareness, but awareness requires stillness. The adaptive trader spends as much time observing as they do executing. They journal their trades, not only to record results, but to understand emotional and structural shifts. They track how their setups perform across market phases: trending, ranging, volatile, low volume. Over time, this creates an internal database of adaptability. They don't need to guess what to do when conditions change. They've already studied it. They move fluidly because their process integrates reflection. Every major evolution in trading psychology happens through failure. The trader hits a wall, a strategy stops working, confidence drops, the market feels foreign. In that moment, adaptability becomes the bridge between despair and development. Those who cling to the old way burn out. Those who adapt reinvent themselves. This process repeats throughout a trading career. Each stage of growth demands a new version of discipline, a new emotional calibration. The trader who resists this evolution remains stuck repeating the same mistakes under different conditions. Adaptability is not just technical adjustment, it's emotional transformation. It means releasing attachment to identity. Many traders define themselves by their strategy. "I'm a scalper, I'm a swing trader. I only trade breakouts." But these labels become psychological prisons. The adaptive trader has no fixed identity. They are students of behavior, capable of switching roles as the market demands. They might scalp in volatility, swing in trends, or stand aside in uncertainty. Their identity is flexibility itself. Adaptability also requires managing uncertainty without panic. The human brain craves patterns, and the market constantly disrupts them. The adaptive trader rewires their brain to find comfort in unpredictability. They no longer see uncertainty as threat. They see it as opportunity. This acceptance of ambiguity builds psychological resilience. It keeps them from reacting emotionally to confusion, and instead teaches them to explore it logically. They know that the market's uncertainty is not something to eliminate, it's something to navigate. The best traders don't aim to be perfect, they aim to stay relevant. Relevance in trading comes from constant recalibration. They read new data, backtest new ideas, and refine their emotional process. They approach each session as if they know nothing, allowing themselves to see the market without bias. This humility is their hidden edge. Where others fall into the trap of believing they've figured it out, the adaptive trader remains a perpetual learner. Always updating, never assuming. Adaptability also reveals itself in risk management. When conditions shift, so does exposure. The adaptive trader doesn't risk the same amount in every phase. They expand during clarity and contract during confusion. They understand that markets breathe, and risk must breathe with it. Accuracy seeks control through static rules. Adaptability seeks harmony through dynamic rules. The trader learns to dance with probability instead of fighting it. Adaptability extends beyond charts into emotional rhythm. Some days the trader is sharp, composed, and focused. Other days, mental clarity weakens. The adaptive trader recognizes this and adjusts behavior accordingly. They reduce size, limit trades, or take a break. They know that emotional adaptability is as important as strategic adaptability, because even the perfect system collapses if the operator is misaligned with their own emotions. The need for control destroys most traders, because it blinds them to flow. Adaptability restores flow by shifting focus from outcome to alignment. When the trader stops trying to force results and instead aligns with what's actually happening, the market stops feeling hostile. Every move becomes communication rather than conflict. Adaptability transforms the trader's relationship with the market, from adversarial to collaborative. The adaptive trader lives in a state of psychological equilibrium. They can pivot between optimism and caution without emotional whiplash. They can experience a losing week without questioning their worth. They can shift from bullish to bearish bias in seconds if the data demands it. Their loyalty lies not with prediction, but with truth. They don't defend opinions, they defend discipline. Adaptability is the psychological evolution that turns experience into edge. It teaches the trader that survival is victory, and that growth is continuous. Each phase of the market becomes a new classroom, each pattern a new teacher. The trader stops fearing change and starts seeking it, because with every shift there's hidden opportunity, not just to make profit, but to expand perception. When adaptability becomes identity, the trader is no longer fragile. They don't need certainty to act or comfort to perform. They trade with fluid confidence, the kind that comes from knowing they can handle whatever happens next. Accuracy wants to be right. Adaptability wants to be ready. The market rewards readiness. It rewards the trader who can evolve faster than it changes. It rewards the mind that moves like water, flexible, reflective, and unstoppable in its quiet strength. Every trader dreams of success, but only a rare few build the kind of mindset that bridges the gap between vision and execution. The difference lies not in knowledge or strategy, but in time perspective. The market seduces beginners with instant gratification, flashes of profit, adrenaline-fueled trades, and the illusion that success is just one big win away. But the trader who truly transforms understands that the market is not a sprint. It is an infinite marathon of patience, repetition, and discipline. The psychology that turns a $100 account into $1 million is built on long-term vision anchored by short-term discipline. Long-term vision is the compass, but short-term discipline is the steps. Without vision, the trader has no direction. Without discipline, they never move. Many traders start with dreams of financial freedom, of wealth, and independence, yet they trade as if every day must deliver proof of that dream. They expect long-term results from short-term thinking. The result is emotional burnout, inconsistent performance, and self-sabotage. Long-term vision demands that the trader rise above daily noise, to see beyond the immediate candle and focus on the structure of progress itself. The market tests patience more than intelligence. Every price fluctuation whispers temptation. Every win feeds greed. And every loss feeds doubt. The mind wants results now. But the trader with long-term vision understands that every trade, win or lose, is a single brushstroke in a much larger painting. They are not judging the masterpiece based on one color. They zoom out, emotionally and mentally, to see how each action fits within a broader narrative of growth. Short-term discipline is the daily ritual that supports that vision. It's the way the trader shows up even when motivation disappears. It's journaling every trade, reviewing every error, following the plan when the emotions scream to deviate. It's the quiet repetition that compounds into mastery. Most traders fail not because they lack knowledge, but because they lack consistency. Discipline is boring. It's methodical, repetitive, structured, and the human brain craves excitement. The long-term trader learns to find satisfaction, not in excitement, but in execution. Every professional understands that trading success isn't about how much you make in a week. It's about how consistently you execute over years. That requires psychological endurance. The market will stretch your timeline. It will make you question progress, test your belief, and tempt you to abandon the process for faster gratification. The traders who endure this test are those who anchor their decisions in principles, not impulses. They remind themselves that compounding doesn't just apply to money. It applies to habits, mindset, and discipline. Long-term vision is not fantasy. It's structure. It's the mental framework that allows traders to withstand temporary chaos without losing focus. It doesn't mean ignoring short-term results. It means interpreting them correctly. A losing day doesn't mean failure, and a winning week doesn't mean success. Both are data points in a long equation. The long-term trader measures progress in the strength of decision-making, not the size of daily profit. Short-term discipline operates like a muscle. It must be trained, tested, and maintained. The trader who treats discipline as optional eventually breaks under pressure. When the market moves unpredictably, emotion fills the gap left by weak habits. The disciplined trader, however, doesn't need motivation to follow rules. They've automated their behavior through repetition. They don't rely on how they feel, they rely on what they've built. Discipline transforms trading from a game of emotion to a system of execution. The mind craves certainty, but the market offers none. Long-term vision compensates for this uncertainty by giving the trader a stable sense of direction. They may not know what the market will do next, but they know what they will do next. Their plan, their reaction, their process. This internal certainty replaces external chaos. That's why long-term vision isn't just a goal, it's an anchor. It keeps the trader grounded when the market's volatility shakes everyone else. Short-term discipline gives life to this vision through micro-decisions. Each trade, each entry, each risk calculation is a vote for or against the future you're building. The undisciplined trader votes for chaos, for emotional gratification at the cost of growth. The disciplined trader votes for alignment. They execute in accordance with their long-term purpose, even when it's uncomfortable. The market rewards this alignment, not immediately, but inevitably. To build long-term vision, a trader must also build patience with imperfection. Growth is nonlinear. There will be drawdowns, plateaus, and moments of doubt. The disciplined mind doesn't view these as signs of failure, but as phases of adaptation. Just as markets consolidate before breaking out, traders consolidate before evolving. During these phases, short-term discipline is the glue that holds progress together. It's what prevents regression when motivation fades. The trader with long-term vision treats every session as practice, not performance. They know that the market isn't just a financial arena, it's a psychological gym. Every loss tests resilience. Every win tests humility. The goal is not to avoid emotions, but to refine them. Over time, this emotional refinement becomes a superpower, the ability to operate calmly in conditions that terrify others. This mental strength is the foundation of scalability. Without it, growth collapses under its own weight. Many traders mistake goals for vision. A goal might be, I want to make $10,000 this year. A vision is deeper. I want to become the kind of trader who can execute with calm precision, regardless of conditions. The first focuses on outcome. The second focuses on identity. Long-term traders think in terms of identity. They ask, who am I becoming through this process, rather than what am I getting from this trade? This shift transforms motivation from external to internal, making discipline sustainable. Short-term discipline, then, is how identity manifests in daily life. It's the translation of long-term intent into immediate behavior. You can't build a millionaire mindset without acting like one in small ways. Every routine, your chart study, your risk management, your self-review becomes a symbolic act of commitment to that identity. Long-term success isn't built by massive decisions, but by thousands of small disciplined choices that accumulate over time. The market loves to exploit inconsistency. It thrives on impatience. It tempts traders into abandoning long-term vision for short-term emotion. The disciplined trader resists this pull. They understand that every impulsive trade, every deviation from plan, every unnecessary risk is not just a bad decision, it's a betrayal of future potential. They treat discipline as sacred, because they know that the only thing separating consistent profitability from chaos is consistency of character. Long-term vision also allows traders to think strategically rather than reactively. They plan around probabilities instead of chasing predictions. They study how the market cycles over months and years, how liquidity changes, how psychology shifts. This macro awareness gives them perspective. They can zoom out when everyone else is zooming in. They don't panic during drawdowns, because they understand that drawdowns are temporary phases within a larger pattern of growth. They see beyond the noise, because their mind operates on a wider timescale. Short-term discipline requires mastering the present moment. It's easy to dream big and plan far ahead, but execution happens now, in the flicker of a candle, the press of a button, the discipline to wait or to exit. Each moment tests integrity. The disciplined trader doesn't see discipline as restriction. They see it as freedom, freedom from emotional chaos, freedom from impulsive decision-making. Discipline turns randomness into rhythm. It's what allows the trader to move in sync with the market rather than against it. Every trader faces the same paradox. Success requires thinking long-term but acting short-term. You must dream in years but execute in seconds. You must hold the big picture while mastering the smallest details. This balance demands mental agility. The undisciplined trader swings between extremes, either obsessing over long-term goals without taking daily action, or micromanaging every trade without perspective. The disciplined trader integrates both. They know where they're going and focus on what's in front of them. Long-term vision builds resilience against setbacks. It reframes losses as lessons rather than failures. It reminds the trader that one bad day doesn't define a career. Short-term discipline enforces structure so that the lessons actually transform behavior. Together they create a feedback loop of progress. The vision provides purpose. The discipline provides proof. Each reinforces the other until consistency becomes automatic. The psychology behind long-term vision is rooted in delayed gratification. Humans are wired for immediate reward, but the trader must reverse that wiring. They must train their brain to value process over payoff, growth over gain. This rewiring takes time and self-awareness. Each time they resist impulsive action, they strengthen that internal wiring. Over time, patience becomes habit, and discipline becomes identity. Short-term discipline thrives on simplicity. The more complex a trader's routine, the easier it is to lose consistency. The most successful traders simplify: same setup, same routine, same rules. This repetition creates a sense of control in an uncontrollable environment. It allows the trader to focus on execution rather than experimentation. Simplicity breeds stability, and stability compounds into strength. Long-term vision is also emotional foresight, the ability to prepare mentally for the psychological storms ahead. The trader expects losing streaks, boredom, frustration, and doubt. They don't react to these emotions because they anticipated them. This preemptive awareness is what separates professionals from amateurs. The professional's mind doesn't crumble under pressure because it has rehearsed the collapse before it arrived. Every emotion has been accounted for, neutralized by preparation. Short-term discipline acts as emotional containment. It prevents psychological overreaction by providing a clear structure. When chaos hits, the disciplined trader doesn't have to decide from emotion. They simply follow the plan. Their rules become a stabilizing force, a mental anchor in volatility. This structure protects them from themselves, and over time, it becomes instinctive. Every long-term trader eventually learns that mastery is repetition under changing conditions. It's not about learning new things limitless, but about refining what you already know through thousands of applications. Short-term discipline ensures that repetition remains consistent even when results fluctuate. It is through this sustained repetition that skill deepens, and through skill that vision becomes reality. Long-term vision shapes confidence. When you know you're building something that extends beyond today, small losses no longer trigger large emotions. You stop measuring success by immediate results and start measuring it by the integrity of your actions. Confidence stops coming from wins and starts coming from self-trust. That kind of confidence cannot be shaken by volatility because it's not tied to outcome. It's tied to identity. Short-term discipline ensures that self-trust stays intact. Every time you follow your plan, even when it's difficult, you reinforce that trust. Every time you deviate, you weaken it. The most powerful traders are not fearless. They are faithful to their discipline. They don't rely on motivation. They rely on momentum built through consistent, disciplined action. Long-term vision requires faith. Faith in time, in process, and in evolution. It's the belief that if you continue refining, learning and executing, results will follow. But faith alone is not enough. It needs structure. That's where short-term discipline becomes vital. It turns faith into action, belief into behavior. Vision shows where you're going. Discipline ensures you get there. Trading is a paradox of patience and precision. You must think like an investor, but act like a tactician. You must hold the vision of the future while executing perfectly in the present. The mind that masters both scales, the macro and the micro, becomes unstoppable. Because when long-term vision and short-term discipline merge, the trader stops being reactive and becomes strategic. They stop chasing success and start building it. One decision, one trade, one discipline moment at a time. Every trader begins with charts, candles, indicators, and patterns. They believe that success lives in the structure of price, in the strategy that can decode movement, in the precision of entries and exits. But as they go deeper into the craft, something shifts. They realize that trading was never about the market. It was about the self that shows up to face it. The charts only reflect what already exists within. The discipline, fear, greed, patience, and confidence that shape their trading decisions are not isolated to finance. They are mirrors of their psychology, their habits, their worldview. To master trading, one must master identity. Because every candle you analyze is a reflection of your own internal state. Trading doesn't just demand technical ability. It demands transformation. It forces you to confront yourself, your impulsiveness, your insecurities, your illusions of control. The market is a constant mirror that exposes your emotional weaknesses. You can hide from your flaws in life, but you cannot hide from them in trading. Every mistake leaves a trail of evidence. Every hesitation, every overreaction, every irrational move is recorded in real time. The trader who refuses to evolve internally will forever repeat externally the same cycles of loss. Growth in trading doesn't happen when you change your strategy. It happens when you change your psychology. The trader who transcends mediocrity becomes something more than an operator of markets. They become a student of human nature. They begin to understand how emotion shapes behavior, how belief shapes bias, and how identity shapes execution. The markets become a living psychological classroom, and every trade becomes an experiment in self-awareness. The $100 trader who transforms into a millionaire doesn't just multiply their money. They multiply their consciousness. They become more patient, more emotionally intelligent, more detached from the need to prove. Identity in trading is not static. It evolves with every phase of mastery. In the beginning, identity is tied to outcome. I am a good trader if I win. This conditional identity collapses easily, because the market doesn't reward constantly, but the mature trader rebuilds identity around process. I am a disciplined trader because I execute well. They separate self-worth from results, creating emotional freedom to operate logically. This evolution is subtle but powerful. When your identity is anchored in consistency rather than success, you become untouchable by loss. You stop oscillating between euphoria and despair. You simply perform. The trader's identity is also reflected in how they respond to uncertainty. The inexperienced trader seeks to eliminate uncertainty. The master embraces it. They understand that control is illusion. There is no strategy that guarantees success, no indicator that predicts with perfection. Uncertainty is permanent, but it's not the enemy, it's the environment. The trader who integrates this truth stops fighting the market and starts flowing with it. Their mind shifts from trying to predict to trying to adapt. They trade from acceptance rather than resistance. This is psychological maturity, when uncertainty no longer triggers fear but invites focus. The deeper one goes into trading, the more spiritual it becomes. It's not about religion or belief. It's about awareness. Trading teaches humility. It humbles the ego that wants to be right and rewards the mind that accepts being wrong. It reveals that the true battle isn't against volatility, but against self-deception. It's a journey from chaos to clarity, from attachment to detachment, from reaction to response. The charts stop being random lines. They become metaphors for life. Trends represent growth. Retracements represent reflection. Consolidations represent stillness. The trader begins to see themselves not as separate from the market, but as part of its rhythm. Every trader who lasts learns that emotional neutrality is not emptiness. It's alignment. When you no longer swing between extremes, you begin to perceive patterns with clarity. You stop overreacting to outcomes and start understanding cycles. You no longer interpret every win as success or every loss as failure. You see both as data. This neutrality doesn't come from suppressing emotion, but from mastering it. The trader becomes an observer, detached, yet fully engaged. They act with precision and wait with patience. Identity also determines sustainability. Many traders can make money for a while, but few can keep it. The ones who do understand that the mind that built success must evolve to maintain it. Complacency is the silent killer of traders. The moment you believe you've figured it out, the market shifts and humbles you. The adaptive trader evolves constantly, not because they fear loss, but because they love growth. Their motivation is not greed, but refinement. Each day they wake up, not to beat the market, but to become a better version of themselves within it. The identity of the master trader is not defined by confidence, but by control. Confidence without control is arrogance. Control without awareness is rigidity. But awareness with control, that is balance. The trader who reaches this balance operates like water. Adaptable, calm, and unstoppable. They flow around obstacles rather than fighting them. They can adjust instantly without emotional disruption. This mental fluidity is what separates professionals from participants. It's not about reacting faster. It's about thinking clearer. Trading, when done consciously, becomes an exercise in emotional precision. Every decision is a test of your internal dialogue. Are you entering from fear or from faith? Are you managing risk from logic or from ego? The trader who listens deeply to these questions becomes self-correcting. They don't need external validation or mentorship to improve. They can diagnose themselves. This level of introspection is rare, but it's where autonomy is born. Independence in trading isn't about working alone. It's about thinking independently. At its highest level, trading stops being about money altogether. Money becomes a metric, not a motivator. What drives the trader now is mastery, the pursuit of internal equilibrium in an external storm. Each trade becomes meditation. Each journal entry becomes reflection. Each challenge becomes transformation. This mindset turns the market into a mirror for personal evolution. Profit is simply the reflection of how disciplined, patient, and emotionally stable you have become. When traders understand this, they stop comparing themselves to others. They realize that everyone's market is different, because everyone's mind is different. One trader's loss is another's lesson. One person's risk is another's comfort. The market is infinite, but perspective determines experience. The trader's job is not to do, but to align. To align with structure, with self and with strategy. True success is not beating others, but mastering your reactions while others lose theirs. The trader's journey, then, is not about reaching a destination, but about dissolving illusion. The illusion that you can control outcomes. The illusion that you can skip growth. The illusion that more money means more success. Each phase strips away another layer of illusion, until only truth remains. The realization that the market is neither your enemy nor your savior. It's a reflection of how you handle pressure, uncertainty, and time. This understanding brings peace. It doesn't mean you stop striving. It means you strive with awareness. You learn to detach from the need for immediate validation. You stop trying to force meaning into every trade. You let your performance unfold naturally, guided by structure, not emotion. This state of mental flow is what all traders unconsciously seek, a place where effort and awareness merge, where instinct and logic cooperate. The market doesn't require perfection. It requires presence, to be fully aware of what's happening without the interference of ego. To see opportunity not through greed, but through clarity. To act not to prove something, but to execute what's already proven. The trader who can do this consistently transcends the chaos that destroys others. They become rhythm, not reaction. Trading mastery is psychological enlightenment through repetition. The trader learns patience through waiting, humility through loss, control through chaos, and confidence through failure. They realize that success is not the absence of emotion, but the understanding of it. That discipline is not restriction, but freedom. That wealth is not accumulation, but alignment. These truths are invisible on the charts, but written deeply into the trader's evolution. When the trader has walked this long road, through losses, through doubt, through reinvention, they emerge with something greater than profit. They emerge with perspective. The same candles that once caused panic now bring peace. The same volatility that once triggered fear now fuels focus. They've learned to see not what they want to see, but what is. They've learned that trading at its core is not about financial growth, but about human transformation. The trader who internalizes this truth no longer measures wealth by balance, but by behavior. They know that the ultimate goal is not just to make money, but to become the kind of person who can keep it with grace, patience, and consistency. Because when trading stops being about the market and starts being about the mind, mastery begins, and from that mastery, everything else follows naturally. Every lesson within this journey connects to a single psychological truth. Trading is not an external endeavor, it is an internal evolution. The market is indifferent. It does not care who wins or loses, who starts with $100 or $1 million. It reacts to discipline, punishes emotion, and rewards patience. Those who treat it as a mirror for growth find that trading teaches more about life than any philosophy could. It teaches resilience, adaptability, humility, and balance. It reveals how the human mind behaves under uncertainty. And through that awareness, it shapes the trader into a philosopher of their own psyche. The story of the trader who starts small and becomes extraordinary is not just a story of numbers. It's a story of psychology, of spiritual endurance disguised as financial pursuit. The long nights studying charts, the quiet mornings before market open, the emotional roller coaster of wins and losses, all of it forges something unbreakable. The trader becomes an architect of patience, a scientist of emotion, and a craftsman of consistency. As each principle compounds, belief, process, patience, emotional control, adaptability, discipline, the trader evolves beyond trading itself. The charts are no longer battles to win, but reflections to study. Every pullback teaches humility. Every breakout teaches confidence. Every consolidation teaches stillness. The trader begins to live life like they trade, with awareness, patience, and intention. The transformation is internal first. The millionaire account is a result, not a goal. The real wealth is the ability to think clearly under chaos, to trust process over panic, to stay aligned when everything seems uncertain. The market doesn't just build accounts, it builds character. And in the end, the trader who conquers their mind realizes that every candle was a lesson in self-mastery disguised as a price movement. Every fluctuation a reflection of growth. Every trade a conversation between who they were and who they are becoming.